Hey guys, welcome to today's session. Going to give everybody a moment to join, make sure all the links have gone out correctly, and then we'll jump straight in. Discord is a go. Seems there's a problem with X.
Yeah.
In 2 moments.
X has been okay lately, but it's weird.
Yeah, look, I mean, to me it looks like it's running, but yeah, because I think StreamYard fixed the issues that we were having. Loopy, is Loopy Rob? I feel like it is. Any name that comes through, I'm pretty sure he's Rob. How are we doing?
Has an R.
Hope you're all good, my friend. Rob, I think I owe you a response, don't I? Yeah. Yeah, about an oil trade. Getting ahead with Dr. Ojo. Pleasure to have you here, dude. Pleasure to have you here. Yeah, it's me. I thought it was. I think, yeah. Loopy's rung a bell from the last live stream that we did. Okay, I think the links have gone out right now.
Yeah.
Perfect. Awesome. Well, welcome, guys. As you can see, we have recruited a new member for today's session. For the majority of you, he will be a familiar face, and I will allow him to do his own introduction shortly. But before we get into that, I need to hand the microphone over to Blayn because he has a bit of a disclaimer that he needs to put out there before we get into the actual optimization session.
Yeah. So interestingly enough, obviously last week we were building the kangaroo strategy, and obviously whoever was there would have known that Martyn actually joined us and was watching along, and called me out on it. I made a mistake, so I only need to apologize to everyone for it. I will re-upload the original file to the strategy development thing. But yeah, I can only apologize. We all make mistakes, but it will be rectified. And interestingly enough, Martyn has actually taken that strategy and is going to be showing us everything today. So welcome to the stream, Martyn.
Cheers. It's great to be here. It's been a while since I've been on a Darwinex video, so it's good to be back.
It's awesome to have you here, dude. I mean, before you jump into it, we've just had a comment come through from Matthias Juptner. I apologize if I've butchered that name. He said, "Hi, I just want to give Martyn a big thanks for teaching me so much already. It's sad your videos have so few views. You deserve to have more." I absolutely agree with that.
Yeah.
And hopefully today we can rectify that for you and for Martyn. Mason, hello chaps, been looking forward to this one. Absolutely, as have I. Martyn, I'm going to hand back over to you because the people aren't here for me and Blayn today. We're all here for you, and I'm super excited for this one as well.
Same.
Cool. Well, hopefully I can share a lot of new content and a lot of new ideas that I've been working on over the past couple of years since I last did a Darwinex video. And hopefully there's some really good stuff there that people are going to benefit from and be able to incorporate into their own trading strategy development process. So it's great to be back, and I really would like it to be an interactive session. So Kieran and Blayn, please do ask questions as I'm going through it, and if there's something that I'm not making clear, probably other people are struggling to understand it as well. So please ask the question, and I'm more than happy for you to pass questions through from the audience in terms of what they're asking as well. So without further ado, I'll crack on. So what I want to do today is, Blayn mentioned that I've taken the kangaroo tail strategy that Blayn developed in FX Dreamer last week, and I've taken that on and to use it as a use case, really. So what today's session isn't about is how do we get the kangaroo tail strategy to work as best as it can in a live account. That's not what it's about. It's just there as a use case or an example, so that I can use that to talk through some of the processes that I take myself and go through some of the decision trees, I guess, in terms of, how do you decide if a strategy is worthy to be traded as a live strategy in your live account, or how do you sometimes make that difficult decision that actually it isn't? As traders, as algo traders, we have this propensity, I think, to fall in love with a strategy that we're developing. And sometimes we want, or we're willing that strategy to work because we put so much effort into developing it, into back testing it, optimizing it, and so on. And we can really fall in love with it so much that come hell or high water, we're going to put that strategy live. And that is the wrong approach. Sometimes we simply have to say, look, it doesn't stack up, and we just have to kill it. It doesn't matter how much time we've spent on it. We have to say it's time to put this strategy to bed and move on to a different strategy. And so I'm not going to say which way the kangaroo strategy went yet, but I just want to make people aware that this isn't about that strategy per se. It's more about the process. Okay. So I'm going to start off with some real basics. Okay. But the basics are so important and are such an important foundation for what I'm going to talk about next, which I'm sure many of you won't have heard of. So you'll have heard of this first bit before, I'm sure. Just bear with me. But if you don't get that right, the second bit isn't on good foundations. Okay, just a quick 2 minutes. And this is, by the way, this is the only slide I'm going to use. After that, it's going to be completely hands-on. So let me just bring this slide up. Okay. So this is just fundamental best practice, but critical to get right. Okay. So different traders will trade for, they'll have different sets of historical data that they use for their backtesting process. Personally, I use 12 years. Okay. And I split that 12 years into two sections, what I call my in-sample data and out-of-sample data. Now, the in-sample data, so that 9 years, so I operate on a 3-to-1 ratio, so 9 years and 3 years. And I do almost everything in terms of the development, backtesting, optimization in this first section of data. Okay. And I really look at this, the last 3 years, the most recent 3 years, as, I don't want to touch that. I do not want to touch that data at any point until the very, very end of the process. Okay. So that I'm sure that my strategy development process hasn't been able to take any information from that data whatsoever. I'm very, very strict about this. So strategy development, any trials that you run. So for example, last week when Blayn was developing the kangaroo strategy in FX Dreamer, he started off with some basic conditions that were looking for those kangaroo tails, as they're called in the strategy. And that was the first thing he built. Tested that, and then moved on to introducing a moving average, okay, and making sure that the current price was either above or below that moving average, and that would set the direction that was allowed. And you also used ADX Blayn as an additional component of that. So as you add in those different aspects of the strategy, it all has to be on this in-sample data. And obviously, as Blayn did, you run back tests, you see how this performs, you see how introducing these filters like moving average filters, ADX, whatever, you'll see how they start to impact and change the equity curve. And I know Blayn didn't run any optimizations last week, but if you are running optimizations, this is the data that you need to do it on. Okay. The out of sample data is what I use purely for validation of what I've done in the first stage. Okay. And by validation, I mean, you know, have I taken a process that is not overly overfitted to past data, and that's why you can't touch this data before this point, okay? Because you want to run your strategy on data that it has never seen or been influenced by before. And I know this is kind of obvious stuff, but there's a lot of traders who do not take this approach, and they will perform an optimization on all the data they've got available to them. And the problem with that is that you then don't have any data to do that validation on. So the only way that you can validate your strategy is on live data, i.e. by putting the strategy live. And if the strategy doesn't perform well in live, you pretty much know you've overfitted at the first stage. So the beauty of keeping this data aside for this process is that you don't have to go through that pain of losing money in the live markets. You can go through the pain by testing it on the 3 years it's never seen. Okay. And if it performs well on that data, then there's a good chance that it will also perform well on live data. Okay. So it's a big no-no to run any optimizations on this using this data. Okay. Now there is actually one exception to that, and I will talk about that a little bit later. But it's not running an optimization for the sake of choosing parameters. It's running an optimization for the purposes of doing analysis in terms of whether you've overfitted or not. Okay, so it's slightly different, but that's the only exception in my view when you should be using this for an optimization. Okay, so the idea is that when you've gone through that entire development process, you should by that point have a good idea about which are the components of the strategy that are most important. Okay, so you might add certain filters in, and you know what, they just don't make very much difference to the performance of the strategy. And so if they don't, what filters do is reduce the number of trades that you have. Okay, or they reduce, I call it sample size. Okay, and the bigger the sample size you have, the more you're able to trust the results that you see. Okay, now I try to, in any strategy, I would try to have at least 1,000 to 2,000 trades in order to view that strategy as having enough statistical significance to give me valid information about whether it's a good strategy or not. But every filter you add in reduces the number of trades. Okay, so you're reducing that statistical significance. So if the filter doesn't have a really big impact on your performance of the strategy, just don't use it. Take it out, because each filter you add reduces, and you end up with a few hundred trades, which isn't statistically significant. And then when you're testing on out of sample, it's kind of difficult to trust the results that you're seeing if you've got so few trades. So only keep filters in if they are genuinely beneficial to the strategy. And if they're not, just remove them, delete the code, whatever you do, or if you're an FX Dreamer, delete the components, because it will not benefit the process of developing your strategy. So when you get to that point of knowing what is important in your strategy, you can optimize on the parameters that you know are most impactful for that strategy. And that is the first time you now use your out of sample data. So you would take the most robust parameter values from the optimization, and you play those out on this data that you've never used before, okay? And you perform this walk forward validation. If that succeeds and you're comfortable that it does perform well, it will rarely perform as well on out of sample as it performs in sample, because there will always be some overfitting. You cannot eradicate it completely. And I'm going to talk a lot about this later on in terms of how we can actually measure whether we've overfitted or not. But for now, let's just stick with the basics. And on your out of sample data, if it performs well, what you can then do is shift your optimization period forwards and perform what I call a pre-live optimization, okay? And this optimization will be exactly the same as the previous optimization you did, because at this point you hopefully know that the process you took didn't lead too much to overfitting, okay? So you want to repeat that same process again. The only difference is here that the most robust parameters you take from this stage are what you will then use in live. And why do we do this? We do it because this data on the most recent 9 years, or whatever you're using, is more in tune with current market dynamics. So it's more likely to perform well on current live data, okay? If you use the parameters from the first optimization, you're kind of, you haven't got anything from the latest 3 years of price action from the assets that you're trading. So you move it forward, perform your optimization, and that's what you then take forward into live trading. Now, apologies, I know that's basic stuff, but it's really, really important, especially for this next bit that I'm going to be talking about. Okay, so let me just stop that. Has anyone got any questions at this point before I kind of move forward?
Yeah, I've got a question, Martyn. So you've mentioned obviously about optimization and obviously to do with filters and things like that. If you have a significant amount of data size, does it matter how many filters you would be applying, or do you have like a potential cutoff point, or as long as everything in the out of sample sort of works, what is your parameters around that?
So there's a couple of aspects to this, okay? So the more, generally speaking, the more filters you have, the more optimizable parameters you have. And generally speaking, if you are performing an optimization on, let's say you've got 7 filters, let's go to the extreme, you've got 7 filters, you've got a regime filter, a volatility filter, a directional filter, so on and so on. Each of those filters will have parameters. And as you introduce each filter, you're going to be doing some kind, even if it isn't a full-blown optimization, you're going to play about with parameter values to get something that works. Now, as you'll see from what I cover in a minute, that's really dangerous, because when you do that, the more parameters you have, the more you are giving your strategy the ability to fit to past price action. Okay, that's really important. So over the last 9 years, I use 9 years for my optimization. So over those 9 years, there are going to be significant numbers of really big moves in the market, whether it's non-farm payrolls, or a Fed interest rate decision, or something Trump has said on Truth Social, whatever it is. Things move the market, in a big way, and there will be hundreds of those in that 9-year period. And the danger of having too many parameters is that you eventually find the parameters that benefit from those big price moves more often than they disbenefit from them. Okay, and the danger there is that you start to not optimize to find a true edge in your strategy. You end up optimizing to those big price moves, and that's really dangerous. Okay, because if you imagine a non-farm payroll, okay, before that news is released, no one knows, or very few people know, which way that's going to move the market. So for a trader like me or you, we simply do not know which way that's going to go. Okay, so to all intents and purposes, it's a random event. Okay, unless we have a strategy that's specifically targeting news, yeah, that's possibly the exception. If it's a normal strategy like kangaroo tail or some kind of trend following strategy or a mean reversion strategy, those events are random, and because they're random, they won't play out in the same way in the future. But if we have tailored our strategy parameters to fit into those events in the past, which were just random, when we put that live or we test that as a validation on out of sample, they're not going to play out in the same way. And the parameters that really benefited from those past events, well, they're just as likely in the future to be on the wrong side of those. Okay, so this is where you get that discrepancy between these are the results I got in my in sample, which look really good, and these are the results I got in my out of sample, which look really terrible. And that is because that is happening. So to come right back to the question you asked, the more filters you have, the more parameters you have. The more parameters you have, the more likely you are to fit to those past random events, and therefore actually miss any edge that your strategy really has.
Yeah.
Okay? So it's a perfect question, and it really fits in with what I'm going to go through next. So thank you for that. And I didn't plant that question. That was a genuine question, but it does really fit in with what I'm going to talk about next.
Yeah. Exactly. I think we've got one more question that's been put to us. It says, instead of using filters, have you tried optimizing strategy with different history regime? Now, I don't understand that question. I don't know if that makes any sense to you or Kieran.
Possibly. So I mean, markets go through different regimes. Okay.
Of course.
They'll go through regimes where they are heavily trending. There's a lot of momentum activity, and of course that will favor momentum type strategies, and they'll work better when markets or the market that you're trading is in that kind of regime. And then there'll be other times when price is just going up and down, and it's kind of a more mean reverting type price action. And that, of course, is where a completely different type of strategy starts to perform well, like a mean reversion strategy, and a momentum strategy starts to fail. You'll get lots of false entries. But I'm not really understanding the question, because that to me is still a filter. Okay, so you would have a market regime filter. If you had a momentum-based strategy, you would try to develop a filter that identified when the market was in that regime, in a momentum-based regime. So it's still a filter, and it will still reduce the number of trades that you're sort of targeting. So I don't know if that answers the question or not, because
I think that's a perfectly good answer. I mean, that makes total sense. But I think that's all the questions for now anyway. So
okay,
just crack on.
Right. So what I've got here, hopefully you can see MT5, okay, and I've got the results from an optimization that I've run. And I wanted to just use this almost as an illustration of what I've just been talking about. Because I think once you think of optimizations in this way, you'll never see the results the same way again. Okay, so this is ranked. So I've run an optimization. I don't know how many passes there were. Looks like there's about
308.
a few hundred passes. Okay,
Yeah, 308.
so we have a result that's at the top. Okay. Results appear at the top of optimization tables like this for two reasons. And it's a combination of two aspects of what you've done in your optimization process. And it's really important to understand this and to be able to distinguish between the two in your mindset so that you can then take appropriate action. So this top performing set of parameters, so you'll probably notice here we've got M, TP, and MA. So these relate directly to the strategy that you developed last week, Blayn, the kangaroo tail.
Yeah.
So if you remember, I understand why you did it. You didn't give them very descriptive names because you had so much to get through.
Yeah.
Just for anyone who didn't see last week, I'll just explain briefly what these are. So M is a multiplier of the average true range in order to set the stop loss distance. That's correct, isn't it?
Yep.
Yeah. Take profit was then a percentage of how far the take profit is from the pending order entry in relation to the stop loss.
Yep.
So for example, with 1 and 50, what that means is that the stop loss would be 1 ATR away from the pending order entry, and the take profit would be 50% of that, so it would be half as close as the stop loss distance. Okay.
Yep.
150, it would be 150% of that distance away. And then MA is the number of periods for this filter, which was the moving average filter. Okay, so I've performed an optimization on that, got a set of results, and the top results here for these parameters of 150, which of course would be 0.5 ATRs, and moving average periods of 110 appear to be the best performing. Okay, but I mentioned before there are two aspects to why that is appearing as the best performer. The first is because of genuine edge, if there is any, in the strategy. Okay, so if you've developed a strategy that does have an edge in the market, you know, it has something that gives it the ability to make money in the markets, the edge of that strategy. That is one aspect that pushes results to the top of the list. But the other is the fact that these parameters of 1, 50, and 110 probably just happened to benefit from these big market moves that I talked about previously, whether it's the Fed interest rate decision or, you know, the French GDP, whatever it is, they benefited from those. Now, the problem as algo traders is knowing, well, how much is that because of edge, and how much of that is because these parameters just happened to fit to that past price action. Okay, and this is the age-old problem that every algo trader faces. Okay, how much of it is genuine edge? Is there any edge in this strategy, or is it just completely random? Now, what we want to do as algo traders is to, if we can, get rid of the influence of past price action, random events, so that we can see the genuine edge of the strategy. Okay, easier said than done, but I'm going to talk you through today the kind of process that I go through to be able to do that. Because what we want to do is, let's say that in reality, these parameters here are actually have the best edge, okay? But they didn't appear at the top because they weren't, by chance, happened to be on the right side of these big market moves. In fact, you know, they might have been on the wrong side of market moves. So despite the fact that these parameters of 3, 150 and 110 have the best edge for the strategy, they've been pushed down the queue because of this overfitting effect. Okay, and this is how I understand overfitting. This is what overfitting for me really is. So loads of people talk about it. Oh, you know, you've overfitted your strategy. But what does that actually mean? For me, it's simply having enough parameters and enough permutations to have some parameters that get overly affected by these past events. That's it. It's as simple as that. Okay. But how do we choose these parameters here that genuinely have the best edge when they've been pushed right down the list? Okay. That's the challenge. And I, over the last 4 or 5 years, this is what I have been making my purpose to actually try to find a solution to. And I've made great headway on this, which is what I want to share with you today. So I want to share, so some of you might and some of you might not know, but I've developed a piece of software that really its sole purpose is to answer this question, is to be able to identify parameters with the genuine edge. Okay, because MT5, these raw results in MT5 do not give you that information. They just perform a very mechanical process of saying, okay, we're just going to play the parameters through on past data, and these are your results. Okay, and that is all that any optimization engine will ever do. They just give you raw results. They don't care how impacted they are from past price moves that were random. You just get the basic results. So I've been looking for the past, as I say, 4 or 5 years at trying to get the edge out of these results. So I have a software product which is called Optimize Strategy. And what I've got here, so the way, just so you understand the way that this works, you run your optimization normally, as you always would in MT5. Okay, but that information then appears on what's called a dashboard. So you have a number of dashboards in the software product, and you can have a dashboard for each strategy that you're developing, for example. So I've got one here that I've called Kangaroo Trials, and I just used it to take the strategy that Blayn gave to me last week to run it through and see what I could glean from this particular strategy. Okay. Now, this is the results of one of those optimizations that I performed, and I'm going to use this to try and explain to you how you can start to identify true edge in parameter values, distinguish that from overfitting effects that you get in every optimization, and how you can start to see the forest for the trees to be able to see the information you actually need. Okay, so let me explain a basic concept first of all. If you imagine in your mind's eye that you're in this environment where there is no randomness, okay, everything, every price movement in the markets is logical, It's based on logical reasons and there's no randomness going in there. There's no news events. There's nothing like this. And there's people just looking at price action and saying, this looks oversold, so I'm going to buy. This looks overbought, I'm going to sell, and so on. Making logical decisions about price action. And if that, of course, doesn't happen, but if that was the case, then you could develop a strategy that targeted some of those conditions. So let's look for when the market is really oversold, because at that point, there's going to be lots of traders who are going to be starting to buy that. And that buying pressure is going to push the price up. I've entered a buy order, I'm benefiting from that. And everything in this ideal scenario is based on true edge, okay? And it would be incredibly simple to develop strategies that just piggybacked on that kind of psychology that was going on in the market. Everything would make sense, okay? And you'd optimize your strategy parameters. And if you imagine what the surface would look like, it would be fairly smooth, okay? It would be fairly smooth. And as parameter values changed, you'd be able to easily highlight, okay, this is the best parameter set here for this particular type of premise that we're trying to target, okay? But as you can see from this, it's far from smooth, okay? So this point here is actually the best performing parameter set from this particular optimization. But if you look at it, all around it, it's just falling off drastically on all sides, okay? And so this is not measuring the true edge of the strategy. What the surface is measuring here is what I was mentioning before. This particular point benefited from all of those random price moves, which pushed it to the top of the list, and it appears as a spike on the surface chart, okay? But you've got values down here much lower that might actually have a really good edge, but these were on the wrong side of those price moves, and so they've been pushed right back down in the surface to low values that you would never in your right mind select, because why would you select a value down here? Okay. So what we need is a way somehow of filtering out the effects of those parameter values being overfitted to those past market events that do not offer any value to us, because they're not repeatable things. Anything that's random is not repeatable in the future. But edge is repeatable. We would expect edge, if we identified good edge in our in-sample, we'd expect that to pass through to the out-of-sample validation. We'd expect it to pass through to the live trading data, so that we're then able to take advantage of that from the optimization. So what I've developed in the strategy is a way that filters out these erratic movements, leaving behind the true edge. Now, don't get me wrong, it's impossible to do this fully, but let me just show you what I mean. So I've called it edge detection. I've recently changed the name of this because I used to just call it neighborhood averaging, but it's doing a lot more than that. It's actually using filters to filter out those rapid changes, which can only be there because of overfitting. So if I turn this on, you can see it's taken away all of those spikes to leave, and what is left behind is much closer to the genuine edge of the strategy that we're trying to target. Okay, so from this, if I just kind of switch this on and off, you can kind of see the effect that this has by taking away those overfitting results. So effectively, the value we saw that was a spike is now somewhere down here. It's much lower, okay, because the effects of that overfitting have been taken away. So now, even though we'd have chosen it in the past optimization, we wouldn't choose it now because it's right down here. Instead, we choose this value, which is more tailored towards that edge that we're seeking, okay? Because that is what's repeatable in our live data when we trade the strategy. Now, another problem that algo traders face is specifically with selection of parameters, is that if you've optimized only 2 parameters, okay, that's fine. You can visualize the results on a surface chart like this. So we've got the parameters for the multiple of the ATR along here. We've got the parameters for the take profit ratio along here. And you're basically looking at all of your data from the optimization in one chart, if they're the only 2 things you've optimized on. But if we've optimized on 3 parameters, you can't view all of that information in one chart like this. You have to look at parameter 1 with parameter 2, first of all, and you kind of look at that and you would select the best parameters from that combination. And then you'd switch over then and look at parameter 2 with parameter 3. Okay. And if you were lucky, parameter 2 that was in both would have the same value, but that rarely happens. Because of the relationships of how these parameters work together, you'd probably get 2 different values for that parameter 2. And then you'd look at the other combination, which was parameter 1 and parameter 3. You'd get a different surface chart again, which again would probably give you different values. So how do you select the best parameters with that in mind? And I'll tell you how most traders do it. They would look at the surface charts, try and do their best to find nice, robust areas on the surface. And then they get contradictory information as they looked at the 3 different surfaces, and they'd say, do you know what? I'm just going to go back here and I'm going to choose the top value because I can't get my head around the ambiguity of all the different values that the 3 different surface charts are giving me. And a lot of traders that I speak to just end up reverting back to the table and they choose the top value. But we already know the top value is there because that was the one that was most overfit to past data. So by going back to this table and selecting that value means that you're effectively choosing the most overfit set of parameter values, which obviously is a huge problem. Okay, so this is something else that I've worked at and I've tried to get my head around and to come up with a solution. Now the solution is that, you know, as humans, as we're analyzing data like this, we can look at a surface chart and we can comprehend 2 parameters like we see here. We can kind of say, okay, so this area here is the best area. But when you add 3 parameters or 4 parameters, it becomes incredibly difficult for us to do. So what I've tried to do within the software is help with that process. Okay, so I have this, I should maybe call this parameter selection. Okay, now what happens behind the scenes here is that this is doing what I call n-dimensional analysis. So even though as humans we can only visualize surfaces for 2 parameters, in code, which is what's happening behind the scenes here, that can analyze surfaces in 4 dimensions, 5 dimensions, however many dimensions. And that edge detection is happening behind the scenes here as well, okay? No matter how many parameters you've optimized on, okay, and I do have a caveat here because I mentioned earlier on, this isn't a magic wand. And the process that goes on here isn't a magic wand. You still need to be sensible. You still need to keep the number of parameters that you're optimizing to a reasonable level. Now, for me, I err on the side of caution with these kind of things. I try to have a maximum of 3 parameters that I optimize in any trading strategy. And that's the 3 parameters that from the work I've done and the analysis work I've done on that strategy, they're the 3 things that have the biggest impact on that strategy. So all of this is a combination of being sensible, combined with using these. So these are algorithms that I've been they haven't been in a commercial product like this for that long. I used to do all of this analysis in Excel. It's only recently I built this into a software product that kind of does it automatically. So now this will analyze that n-dimensional surface. It will apply those filters that we saw visually here, but it will apply them in n dimensions to give you what are deemed to be the most robust parameters targeting the edge of the strategy. Okay, so what we've got at the top here is this is the raw results. So these results match whatever was it. This is a different optimization than the one I showed you because there are only 2 parameters here, the ATR multiple and the take profit ratio. Okay, but these would mimic exactly what you saw in the raw optimization engine, in this case MetaTrader 5. But this bottom table, that's why I put a warning here, do not use these results, okay, because these top results will be overfitted results. The bottom results here in the table, which have filtered out all of that data that was overfitted, are attempting to give you the parameter values that have that genuine edge. Okay, so the main thing I'm trying to say here is that when you look at a table like this in MetaTrader or multi-charts or NinjaTrader or whatever your optimization engine of choice is, just realize that these top values are here for a combination of those 2 things I talked about. Yes, there is some strategy edge in there, but predominantly the very top values are the values that benefited most from overfitting to past data. Right, I've said a lot there. Before I move on, because I've got other things that I want to talk about, but before I move on, is any of that kind of, do people agree with me? Do they disagree with me? Has anyone got ideas? Does anyone want any more information?
Yeah, I mean, Martyn, I suppose I've got another question. I mean, I could be on here all day asking loads of questions. I think it's interesting. You just a couple of minutes ago, you covered the fact that you would do about 3 parameters. So do you include stop loss and take profit as individual parameters themselves that would be part of those 3 optimizations? As in, it's not 3 filters plus take profit and stop loss. It's take profit, stop loss, and possibly one other filter or optimization that you would do.
Okay. So stop loss and take profit, obviously extremely important factors of any strategy. So when I said earlier on that, you know, I identify the most important aspects of the system, stop loss and take profit are usually in the mix. Okay. In terms of filters, my approach there is that when I'm applying a filter to see if it has a genuine beneficial, so I'm just going to put this back here, right? So I mentioned several stages here.
Yeah.
Strategy development, trials, eventually leading up to a final optimization. So I guess when I'm talking about, you know, keeping things to 3 parameters, I'm really referring to that kind of final optimization you do before you then validate against your out of sample data. Okay, so that's what I'm talking about. So if I have a filter for, let's say, market direction or market regime or whatever it is, I will add that into the strategy at an earlier stage, okay, and I might do a light touch optimization on just that filter in isolation of everything else, okay, just to get, and by light touch I mean moving, you know, the moving average one that you talked about, you know, just optimizing one of the moving average parameters, usually periods, okay, to identify, first of all, does it definitely have a beneficial impact on the strategy? If it doesn't, it gets taken out. If it does have a genuinely good impact on the strategy, I'll do a light touch optimization, work out what kind of thing works best, and then that's it. I'll leave it. That probably wouldn't become one of the parameters I would then optimize later on.
Okay.
The parameters I optimize as a kind of a final stage usually have something to do with, as you've already highlighted, Blayn, stop loss, okay? And that will usually be what's the distance, okay? So in your case, you were measuring that in ATRs. Take profit. How do we calculate the difference in relation to the stop loss in exactly the same way that you did? And then something that is related to the signal. So in your kind of terminology with what you were doing in FX Dreamer, you know, that is your initial conditions. So you were looking for you were setting up conditions that looked for the kangaroo tail. So looking for a, you know, bar 2 in the example of a short trade, bar 2, the high of bar 2 is higher than the high of bars 1 and 3. I got that right?
Yes. Yeah.
So that's a rule, okay? You can't optimize that rule. That's just a rule, okay? But one of the things that I did was I added an additional rule that you didn't have, okay?
Okay, interesting.
I just come down to it. Here we go. So these are my, sorry, I have to say, okay, so I don't use FX Dreamer. And so what I did was I rebuilt the strategy that you had. I rebuilt it into my own EA framework.
Yeah.
And because that's just what I'm comfortable with. But the rules up until this point were exactly the same as the rules that you implemented. Okay. And I one of the things I did, and by the way, this is something all algo traders must do, okay, is when you run an optimization, run it using visual mode. Okay. so that you can visually see every trade that's taken, when it's taken, when it closes, and you have to ensure that that is genuinely following the rules you have set up, be it in FX Dreamer or in your code. You know, it's absolutely essential, because I can almost say, you know, without question, if I develop a strategy and I first run it through, it doesn't do what I want it to do.
Yeah.
I'm like, why did it open a trade there? I don't understand. Okay, and you have to go back and debug. Oh, okay, so you work out what it is. And until you get that working exactly to the rules that you have dictated, you know, don't move on any further. Whatever you do, don't start optimizing before you've done that visual sanity check. Okay.
Yeah.
Now, when I was doing this with your strategy, Blayn, what I noticed was, you know, there were huge differences in those kangaroo tail patterns. Okay. So, for example, you know, we've got a pretty good one here on the right. So we've got this big down candle, you know,
Yep.
and the low here is substantially lower than this low,
Mm-hmm.
kind of lower than this one. So there was very much a different quality. So if I show you one that isn't as good, look at this one here.
Yeah.
So here you've got this middle red bar, which is just slightly higher than the two bars either side of it. Okay, so this for me is a very low quality kangaroo tail.
Yep.
Because the middle is only just marginally a couple of pips higher than either side. Okay, so I built, where are we? Here, this, I called it minimum allowed tail percentage threshold. It's a bit of a mouthful, okay? But what this means is that it's looking, you can set this to, let's say, I don't know, 0.2, okay? And if you set that to 0.2, it will look for, for tails that have to be at least 0.2% difference in price terms from the candles either side. So effectively, it's looking for a more quality kangaroo tail, and it's missing out these low quality ones that most people visually would look at this and say, it's not a kangaroo tail.
Yeah.
Yeah. It's just kind of, it's just by chance. It happens to be match the rules of the kangaroo tail. So I did that. Okay. And this is the kind of thing that would be the other thing that I would typically optimize.
Mm-hmm.
So something to, you know, the stop loss distance, the take profit distance, and some key factor that gave me a quality signal. Okay. And they would usually be the last three things I would optimize that I would then perform my validation on. Everything else, yes, kind of light touch optimizations just to make sure that the values are sensible. You know, again, I'd go through a visual test of a trend filter or a volatility filter to try and visually see, you know, is this filter doing what I want it to do, and what parameters do I need it to have to do that, to meet that target of trying to achieve what I'm trying to do with the filter. Light touch, but then leave it alone, and I wouldn't touch it again. I'd get it working how I wanted it to be, and that would be it. So does that kind of answer your question?
Yeah, exactly. Yeah. No, I think it was just important and interesting for others to know when you're speaking about the parameters, you know, what sort of things you would include in that, what you wouldn't.
Very valid question.
I think that's the amazing thing about, you know, the journey as well. Like, you do learn these things over time, but, you know, if I go back to when I first started, if I knew these sort of things early on, it would definitely speed up certain things of my processes that have came in just from failing, essentially, you know. so yeah, no, thanks, Martyn.
Yeah. Okay. Cool. So the other thing that, so I went, there was a website that you used last week. It was called the something trader. What was the website you got the information off for the strategy, Blayn?
It was called the Transparent Trader.
Yeah.
He shares some strategies and things like that I've built just to, it's just a good exercise just to build some of these strategies and test them.
Yeah. And I went to that site, and the guy's got a video on there as well. And I have to say, he looks like he's a genuine guy. I watched the video and I believed what he was saying. He's obviously, got some skills, some expertise, and he genuinely seemed like an honest guy. Okay. But there was one thing that he said that sent this alarm bell off in my head. And this is something that I'm really quite particular about when I look for ideas for strategies. Okay. So he said, this strategy will only work on dollar yen. He said that. Okay. And I know you developed it on dollar yen.
Yeah.
Because that's what the guy said, right? He said,
correct.
It only works on dollar yen.
Yeah.
Now that, when anybody says anything like that, you see it all over the web, right? You see these expert advisors for sale. Oh, it only works on pound dollar. It works on euro dollar, whatever. And that to me is a massive red flag. Because what that says to me is that you've just overfitted a strategy to a particular asset. Okay? If someone comes to me and says, this strategy, it only works on dollar yen because, and they can come up with a valid reason, and they can say, look at the price dynamics here on a chart of dollar yen. You'll notice this particular characteristic of dollar yen that you don't necessarily see in other assets. Okay, and it might be something something it does at the Asian Open. It might be some characteristic you see when the US market's open. Whatever it is, if someone can say to me, it only works on dollar yen because this is how dollar yen behaves at this time of the day, I'm fine with that. I don't have a problem with that. That's absolutely great. Someone has identified a potential edge that can be exploited in a strategy. No problem at all. But if someone's selling an expert advisor and they say, it only works on pound dollar, well, that's it. No rationale, no nothing. You've got to be extremely wary about that. Because in reality, what they've done is they backtested and they fitted to the past data of how pound, dollar, or whatever it is reacted to those big news events, and the backtest looks brilliant. Okay, I'm going to show you in a minute what a backtest looks like on this with more assets added in. Okay, so one of the things I asked Blayn to do for everyone's benefit, I asked him if you could create an FX Dreamer EA that was multi-asset, and we tried, didn't we, Blayn? But we couldn't get it to work.
Yeah, I don't know why. It couldn't get it to working on all the, unless we tested it on all assets on the watch list. That would have been a nightmare as well. So it is a flaw actually, from the FX Dreamer sort of thing.
So that's the reason. Actually, that's the reason I mimicked the system in my own strategy, my own EA framework that does. I've already got it set up to trade multiple assets. Okay, so I'm just going to show you what this kangaroo strategy looks like, because this again is a big warning sign for me. I'm going to show you what it looks like on multiple assets. Now let me just find the right one. I think it's this one here. Okay.
So you got a comment saying, "Hi Martyn, that seems to be the foundation of portfolio development. People develop a strategy for a currency pair, time frame, etc., and combine many of them. This is really challenging for us." And yeah, that's part of trading. It is challenging to find something that is reliable, on to trade live. I don't know what your comment is on that, Martyn, but it's just part of the game in my eyes. I'm afraid it's just
yeah. So you've hit the nail on the head there, or whoever said that has hit the nail on the head in terms of this portfolio aspect. So yes, if you can trade a portfolio of strategies that are uncorrelated, where you might have some strategies that are targeting mean reversion price action, some that are targeting momentum price action. There might be some which are candle based, like this one we've been looking at, the kangaroo tail. Different types of strategy, and if you put them all together, that will hopefully, if you have 3 strategies that are targeting different types of edge, when one's doing well, the other won't be, and that kind of reduces your drawdowns and allows you to get a much better return over risk ratio of that portfolio. That is absolutely something you should be doing. But the danger is that if you have a strategy that only works on one asset, the danger is that strategy has a lot more chance of being overfitted, okay, than a strategy that works well across, let's say, 28 forex pairs. So a strategy that works well across 28 forex pairs, where you might have 25,000 trades, you can trust that a lot more than you can trust a single asset strategy that only has 800 trades. Okay, that's the key difference. So yes, in concept of portfolio strategy, portfolio management, absolutely agree, but you've still got to identify individual strategies that will make up that portfolio that are grounded in statistical significance, okay, which is why I like to trade or develop my strategies against a large number of assets. So this back test you see here is the kangaroo back test. So this one here, no, I'll come to that in a minute. So this is how it performs against 28 FX pairs, okay? So if we go in and look at the analysis of how it performs on a breakdown of those, this is what we see, okay? So the guy who said it only works on dollar yen was actually wrong, okay? Because dollar yen is this end one here. And yes, it performs okay on that in comparison to many of the other assets, but it performs best on pound yen. It actually performs really well on pound yen, also performs well on Australian dollar yen and euro Australian dollar. So you can kind of see the pattern here, and the pattern is that these tend to be the forex pairs that will be heavily traded in the Asian session, but they're also quite highly correlated. Okay, so you can see down below here in the correlation heat map, this allows you to see how correlated different assets that you've traded are. So if we use dollar yen as our basis, okay, and we look at, so dollar yen is this row along the bottom here, okay, and if we look at how correlated that is to pound yen, which is this one, there's a correlation of 0.43. It's pretty high, okay. So, and by the way, this is nothing to do with the strategy. This is just price action. This is the price action of those two assets and how correlated they are. So remember, perfect correlation is a value of 1. No correlation is a value of 0. Okay, so this is kind of halfway towards complete correlation. That's quite correlated. So it's of no surprise that for a strategy that works well on dollar yen, it will probably work quite well on pound yen as well. Okay, so the fact that it works well on these relatively highly correlated assets doesn't suddenly mean that this is now a valid strategy. Okay, just because we can say, oh, it's not just one strategy anymore, one asset anymore. It's 4 assets, so that must be okay. Well, it kind of is okay if those assets aren't correlated. But if they are, then it's really just slight variance of the original asset. So you have to be wary about that. Now, what I'd like to see on any strategy that I perform a backtest on is more profitable assets than unprofitable assets. So I have some strategies where 22, 23 of the assets out of 28 are profitable, and that obviously therefore includes assets that are not highly correlated together. And by the way, I don't know how many of you are using FX Dreamer, how many of you are coding or whatever, but when I was producing videos on a weekly basis for Darwinex, I had a series which was specifically for MQL coding. Okay, and one of I think I did it over 2 or 3 brief episodes. I talked you through step by step how to develop a multi-asset expert advisor, and I still to this day get loads of people who email me and say, this, I saw the video, I converted my expert advisor into a multi-asset expert advisor, and that was the game changer for me. I still get people who contact me on a weekly basis who say that was the thing that turned things around for me. Okay, because if you can produce strategies that you're able to backtest, not individually on each asset, but in one fell swoop on all of those assets. So I'll show you on my. Okay, so you can see here, I just have it as a parameter on my expert advisor, which basically says trade all of these. Okay, and I could put all 28 in there, or in this particular case, I'll run this in a minute. These are the 4 assets that performed well in that particular backtest. Okay, so we just have a look. Yeah, so I'll run this now actually. So I went through that process of identifying the assets that worked well. I then built that into my own, obviously my own expert advisor, and I'm just going to run it. So let me bring up a different dashboard, which I've got. Is it this one? Right, so we've got this one here, okay? So this is one that hasn't got much in it, and it's just, I've created it for the purposes of today. So I'm going to run this this backtest now. I've said that I want it to go to this particular dashboard, which is the one I showed you a minute ago. I'm going to start that. Now, oh, sorry. Let me cancel that because I've got the visualizer on. Turn that off. Start it again. Okay, sorry, this is a little utility I have to give everything. Every backtest and optimization I do, I give a description. And this really, really helps when you come back to look at your results in the future, because you can kind of see what you did, why you did it, and so on. So this is just an optimization on for assets. Okay. So this is now running, obviously, in MetaTrader, and it's the same if you do an optimization. If you perform an optimization, the way it works with the dashboards in optimized strategy is that as soon as the backtest or the optimization is complete, that data automatically gets input into the dashboard. So just it's about halfway through already, so it won't take very long now. So as you can see, this looks pretty good so far. So this is those four assets that I talked about, be it kind of correlated together, but even so, there's some diversification there. Obviously, even if the assets are fairly highly correlated, and it looks pretty good. But the problem is with this strategy, when you test this, okay, so you've just seen that appear in the dashboard there, and this automatically gives you the metrics for the back test, gives you the analysis. Obviously, I've got a much smaller correlation heat map now because I've only optimized on, so I've only back tested 4 instead of 28. But all of this information just gets automatically populated into the dashboard so that you've got it for your own analysis purposes. Obviously, you see different information. If you run an optimization, you then see the surface chart, you see the parameter selection tab, and so on. But again, it just all appears automatically. Now, the problem with this is that you've got a really good backtest, okay? But as soon as you walk forward, validate this, the performance is pretty shocking, okay? It's not good. So you need that validation phase, as I was saying earlier. You need to keep those 3 years of data back without any optimization influence so that you have the ability to do that without just going live on a wing and a prayer and experiencing losses in the real market. Use the 3 years you've got to make those mistakes, and this does not walk forward validate well, okay, which leads me to kind of say, this is not a strategy that I think people should be trading in a live account, not based on the research that I've done anyway. Okay, now guys, we're kind of way over time, but I've got one more thing that I wanted to talk about. Have we got time to do it or not?
Of course.
Dude. Of course. Absolutely. Absolutely. You go ahead.
So there's another piece of information that I used in order to help me to come to that decision about whether this was tradable in a live account or not. Okay, and this is a process that I've developed to answer the age-old question of, have I overfitted my trading strategy? Okay, and bear in mind, I've done a very light touch optimization on here, so it would be pretty. The kangaroo strategy doesn't have many parameters. Okay, so it's pretty hard to overfit it because there's hardly anything you can change. It is literally stop loss, take profit, and I didn't even use that threshold value for the kangaroo tail in the end because it didn't really add that much value. So it's difficult to overfit this strategy because there's so little you can actually change about it. It's a simple strategy, which is the kind of strategy I really like, actually, because of the fact it's hard to overfit. But even so, it's still not tradable, okay? It's still just what you see on this chart here, the equity chart, is just overfitting to price behavior because there's very little genuine edge in the strategy. So the only thing it is doing is overfitting. It's all it's got. There isn't very much edge, okay? And that's evident, of course, from the fact that we saw that there were only a very small number of assets before that were profitable. By the way, this isn't looking at, I know this chart looks the same, but this is looking at entry hour of day here, not the assets. Okay, yeah. So don't think this is suddenly saying all the assets are. It's the same chart, but it's different data that sits behind it. So the only thing this strategy has is the ability to really overfit to price data, past data. Now, what I've done, I've actually written a paper on this, and it's currently going through approval for publication. I don't mind sharing it with you, okay? So it's a process that I call walk forward correlation, okay? And what this does, if you can imagine, I'll draw it out for you actually before I look at these charts. So I mentioned earlier on, there's only one valid reason in my eyes for doing an optimization on out of sample data, and it's for this reason of doing analysis of whether you've overfitted or not. Okay, so I'm going to draw a simple chart. Hope you can see that.
Yep.
Okay, so this axis is your in sample performance. Okay, this axis is your out. Sorry, I can't write with these things. This is your out of sample performance. Okay, so let's take the very best parameters that came from the optimization. So let's say this is measured on profit factor or whatever. So you measure profit factor, and the best one also gives you the best out of sample results. Okay, so you'd plot a point on the chart here. This was the in sample performance, this was the out of sample performance. But you don't just plot the best values, you plot the values that also perform badly. So let's look at the worst performing parameter set in sample. So somewhere here, okay? And let's say that also performs really badly out of sample. So you would plot your point here. And you do that for every single parameter set or parameter values that you used, okay? And you plot them all on here like this. And hopefully you see some kind of a pattern, okay? And if you see some kind of a pattern like this, that tells you something very important. It tells you that if you are making decisions by selecting the highest performing in sample parameters over this side of the chart, you're likely to get good performance in out of sample. Okay, so this is an actual chart from one of my strategies. Okay, so here you can see there's a walk forward correlation here. It's quite high. Again, this maxes out at 1 of 0.881. So this is one of the best charts that I have an example of. Okay, what this means is that, you know, if I selected the best performing one, it happens to be this one here, I get a reasonable out of sample performance from that. And I could select any of these in the top right hand corner and get a reasonable out of sample performance. If I chose really bad performance in sample, I get really bad performance out of sample, which of course is what we want. We want to be able to choose logically and to know that our choices are going to lead to a good out of sample performance. But if you get something that looks like this, which isn't quite as good, there's still a relationship here, okay, but it's nowhere near as good, then this is an indication that the overfitting to strategy edge ratio is not as good as we saw on that first example. So we're not selecting anymore based on good edge of the strategy. We're selecting based on overfitting that has occurred, okay? And then here, when you get this kind of thing, it's very, very difficult to see any real relationship here. And this is a sign that you have overfitted your trading strategy. Okay, so I just very briefly want to show you what the results for this are for the kangaroo tail strategy. Okay, so I've only done this in Excel at the moment, okay, because this is where I've been doing all of my research. But within the next 3 to 4 weeks, these charts are actually going to be built into the Optimize Strategy product. Okay, so anyone who runs an optimization will get an instant idea of how much overfitting has occurred as part of the optimization that's been run. So obviously you can look at this from the perspective of different types of performance metric, and this is what the kangaroo tail strategy looks like based on profit factor. Okay, and you know, there's kind of something there. There is some, you know, I mean, if you look by chance, okay, if you had selected the best value here, that performed pretty well out of sample. Okay, but these are kind of outliers and they're just kind of random. So if you'd then gone to the second best one, it's this one down here. Okay, and the out of sample performance drops significantly. So it's kind of a bit random. If you look at it based on other metrics I tend to like, I love compound annual growth rate over maximum drawdown. I think it's kind of more, in principle, it's more similar to the Sharpe ratio. It's kind of looking at the return or the reward of the system, you know, offset against the risk of the system, like Sharpe ratio does. But obviously this uses the maximum drawdown as the measure of that risk. And I like this metric. But what you get here is completely the reverse of what you actually want. You can see the correlation line through here, and it's actually a negative correlation. That means, on average, if you're selecting the best results, you're going to get the worst. It's only minor kind of negative, but it's still negative, and that's a big concern. And I've also got this other one, which is compound annual growth rate over mean drawdown, and that also is negative. So this just screams out to me and says, you know, the edge of this strategy, there might be some edge of the strategy lurking in there somewhere, but it's really minor, and it's really difficult to target that edge without actually targeting the overfitted nature of the results that you're seeing. Okay, and for that reason, I come to the conclusion that yes, you know, there are some out of sample backtests you run and they look okay, but choosing them is really, really difficult. And you could pick the top item and it would perform well. You pick the second option and it performs dreadfully. The third one breaks even. You know, there's no pattern there, and it's that lack of pattern that leads me to believe that the edge of this strategy just doesn't exist enough, certainly not in its current form, to be able to be traded on a live account. Now, I'm going to ask Blayn and Kieran now, does that make sense, or have I just completely gone over everyone's head with this, or is that...
Yeah, it's different. I've never seen it like plotted like this before. I understand the concept. I think some people might have slight difficulty without like being able to read an explanation over and over.
Yeah.
But like I do get exactly what you're on about, to be honest.
This is the key chart. Okay, if you can understand this is the kind of thing you're aiming for.
Mm-hmm.
Okay. So again, it's in sample performance along here, out of sample on the y-axis. And what this tells you, it tells you straight away, if you are making your selections based on the highest performing in sample, i.e. from your optimization, you're likely to get good results out of sample. And those out of sample results are not random, okay? They're not based on this random price action. So this is what you're aiming for. And if you see this in this type of scatter chart, you know you've done a good job, one. And secondly, you know that your strategy must have some kind of an edge, okay? And it isn't just based on random overfitting to past action. That's the key. That's the key to this.
Yeah.
You know, but yeah, so this is something that is going to be built into the software, so you don't have to do any of this, or you won't have to do any of this manually. It's just going to be there. So anyway, that's pretty much all I wanted to go through, and I wanted to give this kind of a use case based on the kangaroo strategy that you developed, Blayn. And I know you came at this with a completely open mind. It was just something you read about and you developed. But my conclusions are that it's not really a viable strategy in its current form. But that's fine, because that's something, unfortunately, that algo traders have to get used to. Okay, out of every 5 strategies you try to develop, you're going to have 3 or 4 of them that you probably end up throwing away because you don't produce something that is viable. Okay, and for me, that's just the nature of the beast. That is just, unfortunately, what happens as an algo trader.
Yep, absolutely.
But we do it because of that one strategy we do find that we think, yeah, this really does have a genuine edge that I'm going to trade, and it serves you well. And that's why we do what we do, to try and identify that one in 5 strategy. Because once you've got it, you're one of your audience members earlier asked that question about a portfolio of strategies. Okay, you only need one. You start with one, and then you develop another 5. Okay, and 4 of them that you throw away. Maybe one of them you then add into your portfolio, and you've now got 2 strategies. Yeah, and you just keep going. You develop another 5, throw 4 away, one's okay. You've now got 3 strategies you can trade, and so on and so on. And that is, for me, that is the way this kind of thing works. I don't know. I'd be interested to know, Blayn and Kieran. What does 1 in 5 sound about right based on your experience, or is that just me being bad at developing strategy?
I was going to say, I wish I had your brain to get 1 in 5, because if I showed you my whole catalogue of strategies I've built over the past 4 years, I would probably say 2 in 100 go past some of my sort of tests and things. But again, I am building absolutely everything that my eye sees. So I think it depends on, for instance, you might be very selective on what you want to build. I'm not. I'll go out and build. If I find a research paper, I'll build it. If I find a YouTube video, I'll build it, just to kind of disprove some of these theories as well, because I find that I don't mind doing that, because in my mind it's a good learning phase, because now I know that I don't need to even think about taking that live, or I don't, I think for me, I just love building strategies and testing them, and I've got quite a vigorous way of choosing strategies. I'm very, very, very picky. And that's just based on the sort of robustness sort of testing that I do, which what you've done is highlighted. A lot of it is similar to the way that I do things, just not in that sort of sophisticated way with the software that I think, I'm looking forward to using it myself to see, because I've documented so much of my sort of testing and things like that. I'm interested to see how my theories and how I've come to conclusions, if they match with my strategy as well, because I think that's going to be very interesting for me. So yeah, I think. Sorry, I'm just rambling on now. To go back to 1 in 5 for me is a no-no.
Yeah, and I think I think it's probably 1 in 5 now, but you're absolutely right. I can read an article now and pretty much say I don't think that'll work.
Yeah, yeah.
And based on my experience of developing similar things in the past, and they didn't work, so why will this work? And so, and I don't take the same approach as you. I don't build it just to see. I've got to the point now where I think I can kind of say, do you know what? I think this has got a chance, or nah, I don't think it has. I'm not going to waste my time on it. And because of that, I think it's kind of a 1 in 5.
Yeah.
But go 10 years back and it would have been a 1 in 100, like you're saying, because you haven't got that kind of experience.
Yeah, exactly. I mean, for me, I don't mind building anything because as much, I don't know, like sometimes things do surprise me and I'm happy when they surprise me. But I can tell you, like most of the time, it's just a complete failure from getting to the next stage on some of these strategies, most of these strategies. But for me, that's just part of the game. I love doing it. I'm pretty sure Kieran's the exact same. We've tested so many strategies before.
Mm-hmm.
It's so important to go through that sort of stage rather than just build. Okay, it's got a good testing, put it to the live markets. If you want to give yourself a good chance, you need to be very critical and throw everything at the strategy as much as you can to sort of make sure it's valid.
So I've got a question / internal thought to throw your way, Martyn.
Mm-hmm.
And Blayn will laugh because I've told him this so many times. I've never ran on any of my strategies. Bearing in mind, XAQP has, as of today, 33 separate single sub-strategies running. I've never ran an optimization on any of them. I've done manual optimizations, but really, if the base idea doesn't work, I don't do too much work on it. I'm very happy to move on. Now, the reason I've never done an optimization is because every time I do it, my computer blows up and I can't figure out why. So I guess it's a 2-part question from me is, A, do you know how I can run an optimization? Because even Blayn, you've tried helping me, right? And we've sat there and we've watched it and it just freezes everything on my computer. And my PC is pretty good. It's quite powerful. And I can't for the life of me figure out why it just...
I can probably tell you straight away why that's happening, actually. Okay.
Oh, go on then.
So I'll share my screen again. Sorry, just bear with me and I'll show you, okay? Right. Can you see MT5?
No, you need to press present down at the bottom just for that.
Yeah, I did. Oh, hang on. Bear with me. Entire screen.
So there is 2 questions in here right now. It says, "Hi Martyn, really eye-opening. Is the overfitting edge ratio sufficient, or you look at other things too?"
Okay. So what the technique, which I've called walk forward correlation, because it's looking at that kind of correlation between the walk forward results and the optimized results. It looks at every single parameter combination. Okay. So what it's trying to target there, it's trying to get away from luck with your walk forward validation. So what most traders would do, they'd optimize, they'd choose the best parameters, and they'd run a walk forward validation. And most traders would say, if that works, great, I haven't overfitted, I'm going to trade the strategy. If it doesn't work, they'd say, either go back to the drawing board, try and change something, or throw the strategy away. But the results you get using that single walk forward with that single set of parameters is itself subject to randomness and chance. Okay, how well did those parameters get affected by news events in the walk forward phase? Okay, and if they got positively affected, you might think your results are really good, when in actual fact, again, you've just fitted to news events in the future. Okay. Alternatively, you might have an equity curve that kind of breaks even, but it just might have got unlucky with the news events in that walk forward period. Okay, and you actually have a really good strategy with a good edge. Okay, and that's the kind of chance you're leaving it to by just doing a single walk forward validation with one set of parameters. What walk forward correlation does is, instead of that, it looks at every single parameter set and looks for the pattern. Okay, and it's the pattern that tells you whether you've overfitted or not. Okay, and that is like infinitely more reliable than just looking at a walk forward with one set of parameters. And I mean, it's a different ball game completely. Okay, so this has now become the way that I do it. So to answer your viewer, yes, this is the way. This is the first thing now I will do to work out whether I can trust the results I'm seeing or not. Okay, and is the dominant decision-making factor. So hopefully that answers the question. I think yes, this is the primary way that I now make my decisions about, you know, the ratio of how much are we looking at edge, how much are we looking at overfitting.
Yeah, there's another question, but I think we kind of covered it earlier. It says, if I've tested both in sample and out of sample for like 20 years of data and it works, why should I worry about overfitting? I think that comes down to, again, like the amount of parameters that you're putting into the strategy. I think, like you explained earlier.
I think I've just answered that actually. Okay. Yeah, that fact that, you know, you do have to worry about overfitting.
Yeah.
Because you know, the kind of stories you hear, right? Let me tell you the kind of stories that you hear from traders. Okay. I optimized the strategy, I traded it, it worked brilliantly for 2 months, and then it stopped working. Okay. Why did it stop working? Okay. That comes down to the fact that, well, you probably hadn't targeted edge in the first case, and you're always going to have lucky periods. Okay. If you can show me a strategy and it works well for 5 years, for 10 years, then I think you can genuinely say, yeah, I've targeted an edge here. Okay. But if it works well for 6 months, any random strategy by chance can work well for 6 months.
Yeah.
So it's about having that
Absolutely.
that assurance, really, that this has a longer term capability, because you're always going to get that randomness, and sometimes you will get things that look, you know, I did a video on this actually way back, years and years ago. It's on the Darwinex library, and it looks at how many trades do you need to almost give you that assurance that it isn't luck, and it's higher than you think. You know, you're going to need, you know, you can have a strategy that works well over 800 trades that is a completely random strategy. I'd urge whoever asked the question, look up that video, because again, it's something that people come back to me and say, wow, that was a real eye-opener. You know, I was doing optimizations with 120 trades and thinking that was enough. It isn't. Okay. And it isn't enough to run 120 trades or 200 trades is not enough, even in a live count, to know if that is genuinely good performance or not, because there's so much randomness in the markets that we have to be able to handle as algo traders, or as any trader. But I guess that's my answer. Coming back to your question, Kieran, I would think you probably in MT5 has this concept of agents. Okay. Now I've got a pretty high spec PC. Okay, it's high spec. I use the it's got 16 cores. Loads of memory. I think I've got 64 gig of memory. So it's a high-powered PC. But even so, when I'm running an optimization, I can only run it on 6. I've got, haven't I, set up 6 agents at a time. If I try to run any more agents than 6, the memory gets used up and the PC dies. Okay, so what you need to do is you need to go into your agents tab and you need to turn off enough agents until you get to a point that you can reliably run the backtests on. I suggest that's probably what's happening.
Yeah, I think I've got 12 cores. Currently got 6 turned off. But I'm going to try. I'll try
running
off
on 4 cores then,
Yeah, I'll try turning them off. I mean, I might just get new components to my PC.
It will normally the crunch point will normally be memory.
Yeah.
Okay. So if you look at your, on your task manager, where are we? Yeah. So if so my PC is not doing anything at the moment, but what you'll notice when you start your optimization, this line will start to creep up. It'll creep up. And if it reaches about this level, you're good. You're okay. You're not going to be, your system isn't going to be paging. You're going to be all right. If it gets up to here, what starts to happen is your PC starts to use the file system as extra virtual memory, and file system access is really slow. Okay, so I suggest that's probably what's happening, and it's starting to page all of this memory to your file system, and your whole PC just dies. So you need to turn off agents until your memory doesn't start maxing out, and then you'll probably be okay.
Okay. Is there any specific reason why you haven't got 1, 2, 3, 4, 5, 6 enabled, and you've got 1, 3, 5, 8?
There is, because my PC has 8 true cores and 8 virtual cores, and virtual cores are actually running on the same processor they're allocated to, so that's why I miss out. If I chose 1 and 2, that would be using a real core and a virtual core on the same core effectively. Okay, so that isn't a good idea. That's my understanding of it anyway. There's probably some hardware people out there that will tell me different. But generally speaking, I've noticed that works better and faster than having all the cores next to each other. And that is my rationale for why it is, because of those virtual cores. So that's the reason, basically. Yeah.
Interesting.
Okay, perfect. I'll try testing that. The second part, I think Blayn, was it us having a conversation about this, and we were talking about XAQP's performance, and I was saying, well, I've never ran an optimization, and Blayn was like, well, that's probably why, because I've never like got too deep into overfitting a strategy.
Yeah, and that's really good. Okay, if I admire you for that. That is brilliant, because if you can develop strategies without doing that, okay, that's the complete antithesis of what a lot of traders do. A lot of traders, they'll just go full in and they'll optimize on every single parameter in their expert advisor. Okay, some 40 parameters, 50 parameters, and I can guarantee that those people are overfitting. Okay, there's no way they are identifying true edge, and there's no way that they'll ever make money doing that in a live account. Okay, so I admire what you've done, because the vast majority of my own process is exactly the same as that. The main optimization I do is at the end, just before I, it's a final optimization on the really key parameters. But up until that point, if I showed you some of my dashboards, it's just backtest, backtest, backtest. It's not optimization. I run loads of backtests, okay, trying different things out. And I think that's probably the way you work. And I work in that way to a great extent as well. And that's a really great way of working, because it keeps you away from the dangers of overfitting to a big degree.
Yeah, I just try and break it constantly. Whichever strategy that I'm testing, I just try and break it. And because the majority of my systems are so simple, they don't have a lot of parameters to play around with. So I'm usually just testing variances of the stop loss or the target, and just kind of gauging an idea of, okay, so if I add, I don't know, if I increase the target by 50%, does the strategy blow up? Okay, now is that because I'm trading a very sensitive area in the market, or is that because I'm overfitting it? So I'm kind of doing it up here, but never getting lost in trying to find the best metric or the best version of this. So I am excited to do some optimizations, but obviously I'm going to rewatch this session a couple of times anyway, and plug into OMS, because and here's another quick question for you, Martyn. When you put myself big there, didn't mean to that. When you optimize through OMS, you have to add certain lines of code to your algorithms, right? When you then go to deploy that strategy live, do you have to remove that code?
No, you don't have to. You can just turn it off. So you'll get about sort of 7 or 8 different parameters that appear in your expert advisor, and the top one is use OMS. So you can basically just turn that off, set it to false, and OMS code isn't touched.
Okay.
But equally, you can remove it if you want to. Yeah. But it won't slow your EA down. It won't use any resources. In fact, if you look at the code snippets that you mentioned, the first thing is, there's an if statement, and it says, if use OMS is false, do not run this. And you'll see it will not run anything if you set that to false.
Okay.
By the way, you don't need to make the changes manually anymore. There's a utility now. It will just make the changes for you, so you don't have to worry about it. But you can still make them manually if you want. The instructions are there.
I'd rather use the utility. Efficiency is everything, Martyn. Efficiency is everything.
Yeah,
exactly.
But I will say, coming back to your last point, Kieran, good on you, mate, because that approach that you have of simplicity and really simplifying the whole process is superb, because it's the opposite of what most novice algo traders do. Most novice algo traders think that the more parameters you optimize, the better the results you will get. And it is actually the opposite. The more parameters, the less likely you are to get a good strategy. So I think that's why you've got I can't believe you've got 33 strategies, man. That's just unbelievable. I've never known anyone with so many strategies. But you can only get that.
Yeah, right? Have an heart attack, wouldn't he, Blayn, if we told him how many Enrico was running?
I mean, to be fair, I've probably got about 60 running. Not all in IME though. I've got loads just in the background. I do loads of forward testing. It's a constant R&D, to be honest. So, but yeah, no, I think since I've never been a big fan of adding filters to a lot of my strategies. I've always kept them simple as well, and I just think if you can find something that's simple that you don't need to alter that much. Yeah, it might not give you the perfect curve that everyone's looking for in a backtest, but it means to me that it's got a good chance going forward and it's real.
Yeah. Can I just say one thing before, because I sense we're kind of rounding up now. I've kind of made the decision. Obviously, I haven't come on here to sell my product today, and I hope it didn't come across that way. I've come on because I'm trying to kind of share my process and how I work, and I genuinely hope that has been useful to some of the listeners. But I have made the decision. I do sell the product, but I've made the decision to give a really, really heavy discount for anybody who is coming through from Darwinex. So there is a 50% discount for anyone coming through from Darwinex. So, and I'll give you a link to that, guys, so that if you want, you can put that link into the comments of the video or whatever. But anyone who's coming through from Darwinex, as I say, it's a pretty significant discount. But everything I've done today, you can do manually in Excel. I want to be clear about that. You do not need to buy the product. You can do these things manually, and I used to. Okay, but it does kind of take a long time to do, but you can do it. All the product does is it kind of streamlines it. It makes it instant, makes it very, very easy to use. But for anyone out there who wants to use Excel, go for it. You can do it.
Is that a challenge to some people?
I was going to say, that sounded like a bit of a challenger.
I'm not accepting that challenge, though.
No way. I said goodbye to Excel when I left my job as a data analyst a few years back, and I'll never go back. I'll never go back there now. But I massively appreciate that, Martyn. We'll have a conversation afterwards, and if you could send us over the link, we'll stick it into the Discord. We'll stick it into the YouTube comment. What?
Oh man, I've never heard that. I have heard that quite a lot.
I've heard what?
Have you not read the comment?
Oh. I thought you were laughing at what I had said.
Fill me in, guys, because I can't see the comments.
It says, Blayn looks like Luke Littler with a beard.
And the ironic thing is Blayn plays for a darts team as well. they're like
now you mention it, yeah. Oh my god, yeah.
Oh no, here we go.
Wow. That is uncanny. Yeah.
Oh well. Looks like I'll be Luke Littler in the next stream.
I like your name, Blayn. Okay. Jokes over, dude. You'll have to change your name next time you log into StreamYard. Oh god, I got the giggles now. Okay, so yeah, we'll wrap up here. I mean, we've been on for 2 hours, like that. I think that's a record for us. So, Martyn, I just want to say a massive thank you for coming on and giving 2 hours of your time to us as well, and going through some of the stuff that you did. For me, I need to watch that on repeat a couple of times, and also what I usually do with these sessions for like my personal use is I'll go into YouTube, rip the transcript, and then I'll shove it into Claude and help me moving forward. So I'm going to do a lot of research on this, and I kind of advise every single person watching this to do that as well. I think it would be, and we was discussing this before we actually jumped on the live stream today, about getting, as long as Martyn is happy to spare some more of his time with us, bringing him back onto a stream with a profitable strategy so that you can kind of see both sides of the coin. You can see one that, we put a bit of time into. Unfortunately, it hasn't worked. I can't stop laughing every time I look. I need to turn the comments off a second. But also seeing the other side of the coin when, we put some time into something and it's kind of like a happy rainbow, or what's the rainbow at the end of the bridge, at the end of the rainbow, whatever the saying is. It's late on a Tuesday, my brain's starting to shut off now. So yeah, we will get a second session scheduled in at some point over the coming weeks or months. Like I say, again, we're super grateful for Martyn sharing his time with us today, and we will play around.
To take you through that process with a happy path, yeah. To say, look, okay, let's start with a different strategy, one that I beforehand know is going to be all right, and take you through the whole thing, and it will have a better outcome.
Absolutely. And then at the end of that, that strategy can be implemented on the charity Darwin, which is the whole purpose of this series and the whole purpose of these sessions on a Tuesday, where Blayn and I are putting together strategies to implement on a charity Darwin, with the end goal of course, performing well, and any performance fees that are generated being passed on to a charity of your guys' choice. So once again, I just want to say a massive, massive thank you to you, Martyn, for sharing your time with us today. To everybody who's watched this live or watches it in the replay, thank you for sharing your time with us today. And I hope you all have a fantastic rest of your morning, afternoon, or evening, wherever you're watching this from in the world. And we will see you tomorrow in the next session.
See you guys.
Awesome. Enjoy, guys.